Our next guest says the main message to investors is stay sensible, reasonable, and disciplined. Kind of like what your dad would tell you, right? We'll take that. David Bahnsen is Chief Investment Officer at the Bahnsen Group with $8.5 billion in assets under management. David, thanks so much for being with us. What are you telling your clients right now here in the final weeks of the year?
Well, I like all those words, but I like them all the time. Reasonable, sensible, disciplined. I think those are really good habits for investors. But what it means in this particular moment is that I think there's a special allure, a special temptation to not be reasonable. It's one thing when the shiny objects were totally irrational and completely indefensible, and we've seen those manias over the years. But this AI story is a real story. It's very compelling. It's going to be a transformative revolution in American economic life. But that doesn't mean that everybody is playing it in an investably sensible way. Valuations, the just sort of euphoria concerns me, and I want people to be careful.
Where is maybe a more reasonable way to play it here? A lot of folks feel like some of the original names, the OGs, if you will, have been kind of played out. How do you guys think about playing it from here?
Well, and it's not just from here because we've been doing this and it's been incredibly profitable, but it isn't talked about much. But you know what's been a great AI story? IBM. You know what's been a
Yep.
great AI story? Cisco. Now, we know about the Broadcoms and NVIDIAs, and Broadcom was a big dividend grower that we owned for a long time and made a fortune. But the yield got so low as dividend growth investors, we had to sell Broadcom. IBM and Cisco are not AI plays. They're very diversified companies with a deep infrastructure of business that has very strong cash flows. And from that, they pay a growing dividend. That gives us our investment thesis. But you get an AI play on top. There's a significant amount of AI adjacents to it. I think that's a much better way because you're not dealing with 50, 60, 70 time multiples with AI adjacent stories. The pure plays are the ones that are quite rich, as you point out.
I want to step away from AI for a moment and just go into consumer goods and some of the dividend paying stocks we see there. You want to talk a little PepsiCo. Your timing is right on because PepsiCo has now reached this agreement with activist investor Elliott Investment. They're going to reduce their product lineup. They're going to cut costs. They're saying they're going to cut some food prices next year. What's your outlook on PepsiCo? Because I got to tell you, the stock is down about 4% year to date.
Yeah, and that's one of the reasons that I think people should really be paying attention. We like the idea of buying things out of favor, and there are a bunch of names out there up 30%, and there's only a few names down 4%. Pepsi's one of them. And here you have a 4% dividend yield buying now that is going to be growing that dividend high single digits every year. Part of this arrangement with Elliott dealt with a real strong focus on capital return. They've grown the dividend every year I've been alive. I like everything that came out of that discussion with Elliott, but I mostly just like the fact that it's an out of favor stock in an out of favor sector with really strong management. They will right the ship. They will execute. Investors will get paid while they wait.
Is it dividend yield? Is it dividend growth? Is it dividend payout ratio? How do you kind of prioritize the dividend metrics?
Of those three you said, most importantly is dividend growth, but we want to get an attractive yield at purchase. So we're a little different than the aristocrats that'll buy a very teeny tiny yield. We want to get a yield at purchase that's double the S&P 500 yield at least. Our portfolio averages about a 4.2% weighted yield. So that's almost 4 times the S&P. But then, yeah, the growth of the dividend matters because it reflects a strong company that is telling you, we believe we have a sustainable business model.
Right.
We see the growth into the future and we steward and manage our balance sheet in a way that's responsible.
David, I'm looking at WTI crude oil just below $59 per barrel, getting awfully close to the average cost of production for our friends down there in Texas. Chevron, how do you view that one?
Well, by the way, it's nowhere near the average cost of production for Chevron, but you're right. There are some producers in Permian that have a production cost in the high 50s, but the Chevrons and Exxons are significantly lower. That's one of the beauties of the technology advancement, especially in the Permian. You have a pretty low cost of production there. Chevron's one of the most underappreciated names, I think, in the space. I mean, we really prefer the larger names because Some of the other names are more volatile and more levered. And Chevron and Exxon have just proven over decades of everything you can imagine in macroeconomic up and down activity, they've continued to grow the dividend through COVID, through the Valdez spill, through the financial crisis. Those are dependable names long term. Short term, Chevron's going to do better closer to 70 than closer to 60, but it's still a range in which they're very profitable. And they actually gain market share from competitors.
David Bahnsen, Chief Investment Officer at the Bahnsen Group. I love that you brought your stock picks. So I'm going to dive into Blackstone. Big underperformer here this year. Stock off 11.5% year to date, but you say this presents a great buying opportunity.
Yeah, let's remember too what it was up in the 2 years before that. You had just such massive, 80% gains, 40% gains, and they gave some back this year because the stock was ahead of itself. But what did they do from an operating standpoint this year? What did they do in the marketplace this year? They gained hundreds of billions of dollars of fee-paying assets under management. They've solidified their position, and it's not just private equity anymore, which is now well below 20% of their total business. It's infrastructure, it's private credit, and they are the major real estate player in the entire world. We love the fee-paying assets. We love as an investor in Blackstone, we're now aligned with management. And then they're out there generating investments. They have an incredible track record, but this is a real elite play. And we think that the business model is very investor friendly, and they return most of those profits to shareholders in the form of dividends.
All right, David, thanks so much. Appreciate that. David Bahnsen, CIO of the Bahnsen Group. Appreciate getting a few minutes of his time.